Hi, this is Christian Dy and Gary Wong. It is August the 14th, and we're talking about cash flowing real estate in Vancouver. This is actually the second talk we've given. The first talk we gave was cash flowing real estate in central Vancouver, and today we're talking about the Lower Mainland as a comparison. If you did not if you missed our first talk and you would like to listen to the link of the recording, email me at the end, and then we will be sure to send that out. So let's get right into it. So cash flowing real estate, and we're looking specifically at the Fraser Valley today. Gary Wong is a realtor inside Vancouver, a very popular guy. He's got the VancouverRealEstateTV.com. He's got his YouTube channel, and he's also an author of the book called Vancouver Real Estate: How to Buy It, Sell It, and Profit from It. So who is Gary Wong? He is a real estate board medallion club member. He has sold over $176 million in real estate. He is a recipient of the Award of Excellence in multiple years. Gary, thank you for joining us over here.
Yeah,
And
thanks
Gary,
for having me.
yeah, remind me, Gary, if people wanted a copy of your book at the end, they could email you for a copy. Is that
That's
correct?
right. So they just email me and I'll send them a copy of ebook. If they ever have a consultation with me, I give them actual physical copy in person.
Oh, perfect.
Yeah.
Fantastic. All right, so let's get right into it over here. We're talking, last time we had this talk, and you and I talked specifically about Vancouver
Yeah.
and cash flowing real estate. And the quick answer to it, it was possible to cash flow in Vancouver, but the real trick was the down payment, how much
Yeah.
you
It was
put
like
down.
30 to 35%.
Yeah, and then you
Yeah.
narrowed down to three areas that you really liked. And like I said, if anyone was interested in Vancouver specifically, just email us at the end and then we'll get you a link to the talk we gave a month ago. But we're now talking about outside of Vancouver core in the Lower Mainland. And this over here is a map for those of us who aren't that familiar. So we're kind of going to the outer edges over here, but not too far. So what Gary has done is he has narrowed down his top three cash flowing areas in the Lower Mainland. So let's start with the first one. Okay, Gary, go ahead.
Yeah. So the first pick I would choose would be Abbotsford, specifically Central Abbotsford. Maybe like 5 or 6, probably 6 or 7 years ago, I had been approached with somebody from Calgary who wanted to buy a property and they wanted to have it cash flow. And they had actually obtained a copy of my book at that time. And then they're interested in investing in Vancouver, but they had specific criteria with like it had to be positive cash flow, it had to be like 2 bedroom, etc. And then what I ended up doing was I sold them a property in Abbotsford, and specifically in central Abbotsford. It was a 2 bedroom, 1 bath. At that time it was $99,000 and it was like renting out for $800. So almost a 12% cap rate, or almost the 1% rule is what I call it. 1% rule is when the rental rate is equal or greater to 1% of the purchase price. Okay,
Yeah,
so
yeah.
sorry.
Let's. You scanned over that pretty quickly. Give us the 1% rule one more time, a
So
little bit slower.
1% rule, like let's say you have a $300,000 condo,
Yep.
1% rule means that your rental rate would be $3,000.
Mm,
Yeah, 1% of the purchase price, so $3,000. That's quite difficult to find in
absolutely.
Vancouver.
Yes. Yes.
Abbotsford at that time, $100,000 condo would rent out for $800 or $900, so almost 1%,
All right.
but
Right.
not quite.
Got it. Got it. Yeah, when you're
Yeah.
looking at numbers like that, what I found is that, you want to go into an area in not a very centralized city area. So I guess Abbotsford 5, 6 years ago was a little bit closer to that criteria.
That's right. That's right. So the next slide just zooms in on central Abbotsford, which is where I sold in. So obviously it's development and infrastructure in the city has increased significantly since in the last 6 years. And so the next slide, it just shows you a couple of reasons why I like Abbotsford. on the left-hand side, I used to be a part of a lot of real estate investment clubs. And I got this chart back in 2016 on what the prices of condos were back then. So there were like, 14 houses, 14 condos below $100,000, etc. But nowadays, three reasons: asset appreciation. I just did a search like a couple days ago. There's no more less than $200,000 condos in Abbotsford. And one of the concepts I teach my clients is that it's much easier for $100,000 condo to appreciate to 200,000 than for $1 million house to appreciate to $2 million. Both is just 100% increase, but it's a lot easier for $100,000 condo to appreciate to 200,000. The other
Yeah.
reason, sorry, go ahead.
No, I was about to kind of reiterate that. Just full disclosure, I actually own a place in Central Abbotsford, and I bought it. I want to say, yeah, about 5-6 years ago as well. It's done incredibly well, and it was a 2-bedroom condo. And I kind of liked. It's not the only thing I own in Abbotsford. I do also own a house out in Abbotsford, but I guess what I'd like to say about Abbotsford, the economics behind it were pretty solid back then, and they still hold true today. And these are the things that I liked about it when I was investing in Abbotsford, which I own 2 places in. Number one is that they have got 3 institutions in close proximity, which are recession proof and you cannot move. One of them is their major hospital. The other one is their University College of the Fraser Valley. And the other one is the airport. And when you have 3 institutions like that, plus you get the big box stores that have already come in, then that's kind of showing you the wave that this is not going anywhere. They're going to get more, their infrastructure is being built for more population, not less population. And back then, that's what I liked about it, which is why I invested in it. But all of those drivers are still correct today. And from what I've seen in rental appreciation, that I don't think that's going anywhere.
Yeah, that's great. Yeah, like we talked about last time about how important it is to follow where the big box stores set up shop, because they've spent millions of dollars doing the research on demographics, job stability, etc. And so you just follow where the big box stores are investing in or setting up shop. And then the population and economic fundamentals in that area will increase.
Yeah, absolutely. Yeah, absolutely. So here you did a little search, and you've actually taken a live listing over here, it looks like.
Yep,
And I kind of I felt that you just kind of found the least
that's
expensive
right.
entry level. And so
That's
tell
right.
us a little bit about this.
So like I said, I did a search a couple days ago. There are like I said, no condos under 200,000. The cheapest one was this one, 215,000. The other ones were in the low 200s. And 1 bedroom, 1 bathroom, George Ferguson Way. It happens to be on the same street that I sold in 6 years ago. I've seen a couple of these back in the day. 1 bedroom, 1 bath. They have larger 1 bedrooms because it's a little bit older, 1976. 757 square feet, rentals allowed. Has a parking stall. And when I help my clients look for properties like this, as long as the strata docs are okay, I go through the strata docs. Looks like, if they have special levies, okay, let's see how much the special levies are. Oh, is it 5,000, 10,000? Okay, so I'd add that to the price. So let's say 215's got a $10,000 special levy. So 225, you do analysis and see whether the numbers work. And so in the next slide, we talk about the numbers. So I
Yeah.
just took that particular listing and I plugged in the numbers. I know rental income now would be $1,200 per month for a 1 bedroom. And then I put 25% down, and 25% down, I calculated the condo fees. I took the property tax divided by 12 and I entered the property tax per month. And then I put a mortgage payment, 2%, 596, insurance, $30 a month. Repairs and maintenance, that's your basic, your own contingency, just in case you need to maintain the property for whatever reason. So $100 a month. And then over a year, your rental income would be 14,400 minus all those expenses. You're still at a positive cash flow of $79 per month. And then divided by the net operating, divided by your down payment of 25% down equals up 0.1% positive cash flow.
Yeah, like I like that you added in the cap rate over here because it helps us to compare against other properties, and to remind people what a cap rate is.
Yeah,
A cap rate is essentially a metric which compares one property to another, even though they're at different price points. So it would take your net operating income, so all the rent coming in, subtracted from all the expenses going out, but not including mortgage though. You don't
correct.
include mortgage. So take a rental income coming in, subtract all the, the strata fees, the property taxes, the insurance, the vacancy, the capital expenditures, subtract those numbers, annualize it, then divide it by the purchase price. And what you're going to get is a percentage. Now, the higher that percentage, the better, because that percentage will be high if the rent is high or if the price is low. So here, this one's got an approximate cap rate of about 3%. And so let's kind of remember that number when we compare it against the other properties that Gary is showing us. But this sheet over here is fantastic. And remind me again, Gary, if anyone would like to meet with you and to get a copy of this analysis, and you can kind of show them how to use it, that's also possible.
That's right. That's right. If they email me, I can send them a copy and like help them do a particular analysis on their property. Yeah. And for sure, like you were saying about the cap rate, like a 3% cap, is that good or bad? Well, it's relative to what the neighborhood is, the cap rate in the neighborhood. What if the cap rate in the neighborhood is, for example, in Vancouver, downtown Vancouver, for commercial, the cap rate's around 1%. So if you can get a cap rate of 2 or 3%, that's actually great in commercial in Vancouver. Well, likewise in Abbotsford, okay, we have an approximate cap rate of 3%. Well, we have to calculate the cap rates of the area. Is it around 4 or 5 or 6%? In that case, this would be a low cap rate. But if the cap rate in the area is around 2%, then this is a good cap rate. So it's relative.
And the other thing in real estate, this is why we always suggest that you have a team behind you, people who know what they're doing, because you can't just buy a place based off cap rate. And the reason is because, maybe the cap rate is fantastic, but maybe the capital appreciation is very low.
That's right.
Maybe it's going to, Vancouver, certain areas might have a low cap rate, but maybe their capital appreciation is projected to be, 6, 7, 8%. You might find a better cap rate in another area, but the capital appreciation is only 1%.
Yeah.
And so it depends, especially on a strategy, what you're looking for. Of course, what you're hoping for is high capital appreciation and high cap rate.
Yeah.
All right. Okay. Let's talk about your second pick here.
Yeah. Chilliwack is my second pick. I've also seen, brought my clients out there and checked out a lot of properties. So the next slide just shows you a map of Chilliwack. And obviously they have like a lot of city infrastructure. So they have the general hospital and a lot of like schools and such over there too. So the next slide is just basically the reasons why I like Chilliwack. Chilliwack has changed quite a bit in the last 5-10 years, of course. Likewise to the other cities as well. 4 reasons why I like it. Well, positive cash flow is one huge reason. Rental rate for a 1-bedroom is approximately $1,000. I did a search as well. Inexpensive, there's like low price condos starting at $150,000, even cheaper than Abbotsford. And like I did more searches, 18 condos under 300,000. There's a high rental rate appreciation in Chilliwack. And of course, the reason I invest in any area is the economic fundamentals, population, job growth, GDP. So I picked a specific case study for this. And like I said, I did a search. The cheapest property I saw was 154,000. 1-bedroom, 1-bath, rentals allowed. I only, when I say I did a search, I filtered the search. It has to be only rentals allowed. Like if any rentals not allowed, I don't consider that in my search, or any rentals allowed with restrictions, I don't consider that in my search. So like no rental restrictions, The cheapest one is 154,574 square feet. It's got a parking stall, 48 units in the development. So pretty good. So I did an analysis, like this was the next cheapest one was around 180,000. So this is the asking price, not the sold price. So there might be some room for negotiations.
Yeah,
Oh,
I guess to add on to Chilliwack over here, which is also another place that I own in.
mm,
Some of the fundamentals that I really liked is that there were plans to revitalize the downtown core. And if you were to drive in downtown Chilliwack, you're actually starting to see that now. Sort of these new just these new developments. I know the mayor was talking about, he had a 5-year plan, and that was about, I think, 2 years ago, to put quite a bit of money to clean up the downtown core, bring more businesses in, give it a sort of a fresh outlook. And that's not even including, you know, the regular real estate market being pushed up just because more people are moving out there, just because everything is going up. So I kind of like Chilliwack for its price point. I like if somebody needed a smaller, and like Abbotsford, I think is going to do great. But I think for Chilliwack, its price point is a little bit nicer because it really, really, really is, you know, for that type of person who wanted to invest in a place, 20% down payment, but on, let's say, a $200,000 property in Chilliwack, that's still that's still possible, you know, whereas in a lot of other places, that's not quite possible over here.
yeah. One of the things I like about these older condos is that sure, the maintenance fee might be a little bit higher, but the property taxes are significantly cheaper. So I calculate that into the cash flow analysis and it balances out.
Yeah, no, that's great. That's great. So
Yeah.
here's your analysis on it. The first thing I kind of want to point out over here, the cap rate off of a 20% down payment is closer to 4% now.
Yeah.
Looks like this property of yours that you've analyzed, you're estimating about 1,000 a month in rent, which is about
That's
right.
right.
Yeah, yeah. All right.
Yeah.
Any other highlights on this one?
This one, as you've noticed, that you don't have to put 25% down as like Abbotsford. This one, you only have to put 20% down and your positive cash flow. So you're positive $742 a year, which is 2.4% return. So it's a lot better than Abbotsford based on this particular property, right? And then obviously like I mentioned last time, the yellow bar is the cash on cash return. The orange bar is the cash on cash plus equity, the equity that the tenant is putting into the principal of the mortgage. And then the green bar is including asset appreciation.
Yeah, yeah. And then it looks like over here for repairs and maintenance, you've got about 1,200 for year one. And then you slowly have that going up probably with
Yeah,
inflation
that's right.
over there.
So every year I add a 3% income and 3% expense to this spreadsheet.
Yeah, I guess some other things to highlight over here. You didn't put a management fee because it's probably close enough for you to manage it
Yeah,
yourself. But if you were, then of course you'd want to add a number in there. And typically, I find I'm actually using someone out there, and I believe they take about 8% of rent.
yeah.
Yeah, it's around there. Yeah.
Yeah.
Okay. No, this is great. Let's go to pick number 3, our final pick, Langley.
So Langley is one of my favorites. It's a little bit closer than Chilliwack and Abbotsford. So this slide is just a map of Langley and 4 core reasons on the next slide of why I love this place. For Langley, everyone knows about the Surrey-Langley Skytrain being approved. I tried to look up in the City Hall website, and I highly recommend you guys to whatever area you want to invest in, look at their City Hall website and look at what kind of infrastructure that's going in the community plan. That's really great. That's what realtors use to study the city. That's what investors use to study as well. Real estate investment clubs, they just read those development applications, then they read what is on the City Hall website. I looked it up, no specific timeline in discussion, but just the fact that they have approved it tells you that population will increase and there's a lot more, there will be a lot more investors jumping in that area. Number 2 reason, asset appreciation based on just the infrastructure increasing, like the more infrastructure in the city, Number three, as always, strong economic fundamentals, like I mentioned, the infrastructure. And number four is what I've been seeing in the market recently is that in the last year, due to COVID and due to employers allowing employees to work from home, a lot more people are moving out of the city, out of the Vancouver core and moving out to like Maple Ridge, Langley, Surrey, and Abbotsford even. And they're okay with that because they don't have to commute. And so due to COVID, it's more common than before to work from home. And so whether they live an hour away from downtown, they don't mind because they don't have to commute to work. So that's another reason.
Yeah, definitely. And of course, we've been talking about Langley with our clients for a while for people who wanted a place in the Lower Mainland as an investment, as a long-term investment. And we were just basically saying, because of the Skytrain line, and we were saying, having this conversation about 8 years ago when in the Tri-City area when the Evergreen line hadn't come in yet, and we were saying that it will probably do better capital appreciation than places same price point, just not on the Evergreen line, and we were correct. This is the same thing. If you're taking sort of a blanket, Langley right on the Skytrain line, let's say two or three bedroom condo, and comparing it with, let's say, a Burnaby 2 or 3 bedroom condo. Take a look at it in 10 years from now and just look at to see which one has had a greater capital appreciation based regardless of price. And what we find is that any place where something new is coming in, such as a transit line, you're going to get a bigger kick out of the capital appreciation because of the Skytrain and the transit, as well as when infrastructure comes in and more population comes in. I was actually experiencing that with some of my Surrey properties probably 15 years ago, when Surrey's full Skytrain line wasn't quite fully developed. And anything really, really close to that Skytrain line, much faster to rent, you yield a higher rent from it because now people have the option to commute into downtown or wherever they're going. You got students who are coming in who don't have cars. You've got young people who choose not to have a car. So definitely a solid pick.
That's right. So the next slide, we actually picked out a case study in Langley. So like the other two searches, I searched for the cheapest rentable condo in Langley, and you can actually find something in the $299 range. Sure, it's a little bit older, but this is a 1 bedroom, 1 bath. It does have a parking stall, even though in this on MLS, the listing agent forgot to fill out the total parking. It's actually, there is a parking stall in there. And then, 710 square feet. Allows pets. And then in the next slide, I actually do an analysis on this.
Oh, wow. No, this is, this thing looks great. It's again, it's probably on the lower end of the price point, but at the same time over here, tell me what's this proximity to the projected Skytrain line?
It's nearby. It's not like right at the Skytrain line, but for $300,000, it's pretty darn good. I would buy it just because it's.
All right. So this over here was your analysis on this one.
Yeah. So for this one, in order to positive cash flow, I did the numbers. You need a 25% down based on a 30-year amortization. The rental rate in Langley is higher than Abbotsford and Chilliwack. It's about $1,400 for even with this one. This one is actually renovated. I didn't show any pictures, but I looked at the pictures. They're decent, not like luxury not luxury renovations, but decent renovations. So about $1,400 a month for your rental income. Condo fees, 300 something. So your net operating expense, 407. So your positive cash flow about $22 a month or $273 a year. So your cash on cash is 0.4%.
Oh, yeah. No, this is great. And it's really important to be able to make these comparisons, when working with a realtor. And if somebody said, hey, I'm working with you as a realtor and I just want a really good investment, but I want to stay inside the Lower Mainland. This is the type of analysis a guy like Gary can do. He can sort of say, here's the pros and cons of each of these areas. Here's the three things that I've narrowed down to. But really what's going to happen is you're probably not going to run to the absolute cheapest thing out there. You want to kind of compare it and, you know, see what you're comfortable with, look at the area. You're going to want to see, you know, am I renting this out myself, or am I going to get a property manager? And then slowly, it's a slow process, but over time, you'll find the right property that's for you.
Yeah. So all these numbers I was using was like conservative. So like, yeah, if you have more specific, like if you have specific questions, I would definitely like, you know, reach out to me. I'll have a conversation with you and go into more details.
Yeah, absolutely. And so like, I'll give you an example of what I do here at Latitude West Financial. So, you know, I get couples or, you know, single people that need financial help sort of beyond, you know, what whoever's helping them with the RSPs and TFSAs are doing, or maybe they're doing it on their own. So here's a good little case example. You know, imagine a married couple who own a home, but they want to upgrade their home, or they're talking about maybe investing in another property or using some of the equity because their house has gone up quite significantly. So then we'll talk about options, and we'll sort of say, you know, Christian, my wife and I were talking, and we're thinking of selling our house to buy a larger home. But we're also thinking of selling our house to actually buy a smaller house, but to invest in another property. So now we have a rental income. Sort of a lot of people are making money in real estate. We wanted to do the same as a rental property. Or they'll say, you know, maybe, or what we both love to do, if it's possible, is to keep our house, maybe leverage the equity to buy another investment property. But we've been toying this decision for well over a year now, but we haven't made a move, and we keep thinking we've missed the boat. Well, the reason why they haven't made a move is because they're not sure what they're doing, and it's such a big decision that they need help with this. And they kind of feel, you know, where can I get this type of help? Well, that's what we do here at Latitude West. We're absolutely able to help with this because we are financial planners, but we're able to we're able to advise on not just, you know, stocks and real estate, cash flow, but we're able to advise on real estate as well. So as advisors, as strong financial advisors, we take a discovery meeting, which doesn't cost anything. So we invite people to take a discovery meeting if they're hoping to make a move that involves real estate, but they're a little bit confused. So the discovery meeting is us trying to figure out what you're trying to do, trying to collect that information. And then if we did end up working together, we would navigate possible solutions. We would then help you to implement the solutions, and then we'd make sure that you stay on course by having periodic check-ins. So that's our Latitude West process. We're able to do the analysis to see whether buying 2 properties makes sense for your scenario, or even 3 properties, you know, and we can use to see leverage off of your existing real estate, or, you know, starting fresh, or maybe even utilizing other funds from other assets. But what I found is that people should be using advisors. Statistics show over and over again that if you do use an advisor, you are going to be better off in the long term, as opposed to if you try to do this on your own. But the one thing I will add is that it's hard to find an advisor out there who will help in areas outside of just the stock market. And I think that's where we come in. A lot of people, they kind of have their stocks and their bonds and their RSPs and TFSAs kind of under control, but they don't have enough help when it comes to making large real estate positions, such as investment property, such as, you know, playing around with the equity in their own personal home. So that's where I invite people to, you know, by all means, connect with us and let us know if you'd like to take a complimentary discovery meeting. So right now is a good time for, if anybody has a question, to throw it in the chat. If you're listening to the live webinar right now, put it in the chat and we'll be able to field this question for you. While we're waiting for those questions in the chat, Gary and I will be doing a part 3 to our cash flowing real estate series, but this time it will be in a couple months from now in October, and we'll be comparing BC with other provinces. So I myself am looking and helping my clients to invest in not only BC, but in other provinces, and I myself have invested outside of BC. Gary is one of those
Yeah.
experts who can compare to say, does it make sense to stay in our own backyard in BC, or whether to look at these properties outside of BC. So that one, stay tuned, October 9th, Saturday at 11 a.m. I don't think we've put the registration on my website yet at Latitude West, but it will be on there shortly. And we also will be able to get you guys that invite for that as well. So whenever you want to register for something, it's at latitude-west.ca/workshops. Like I said, we will be adding this one on shortly.
Yeah, I'm excited to talk about that that topic about BC versus the other provinces. I have a lot of clients who invest in Edmonton and Toronto and Windsor, Ontario, and some in St. John, New Brunswick. And yeah, I have a lot to say about that, so there's a lot of different factors on, that kind of stuff.
Absolutely. Like I think one big one is going to be, cap rates versus capital appreciation,
That's right.
and I think that's where the big debate is going to come. But if you want to see more of Gary, he's got this YouTube channel, and at vancouverrealestatetv.com. He also has podcasts. And like I said, he's the author of the book on Vancouver real estate, and this could be available in English or in Chinese. And he is also able to share with you his real estate acquisition formula. And if you ever wanted to take a look at getting some help with the Excel analysis. Here's a question, Gary. It says, could you explain a bit more about the 5+ year column in the Excel analysis you showed? So I'm going to sort of go back a little bit here. Okay. All right. Okay. So in the 5+ year projection, someone is asking, can you explain a bit more about the 5+ year column in the Excel analysis you showed?
Yeah, so I just basically did the accumulation. Like every year you go up, I increase the revenue by 3% and I increase the expenses by 3%. So a summary of 5 years, that's the summary. Basically, I added it all up. Right.
Oh, I see. I see. So it's kind of like it's a cumulative average of the first 5 years.
That's right. So like approximately after your 5 years, well, what's your return after 5 years? So cash on cash, you'd be 1.9%. The cash on cash plus equity, 40.3%, and the asset appreciation, 150.8%. I just added them all up.
Got it. Yeah. And the return on investment, of course, is taking into account the asset appreciation, but it's also taking into account the pay down of the mortgage. Is that correct?
That's right.
Perfect. Oh, excellent. Okay. So let's see if there's any other questions. Feel free to put them in the chat. But let's see over here. This is how we can. Okay, here's our next question. Are condo apartments better investment for cash flow, or townhouses, or split level homes where you rent both the upstairs and the basement? Oh, I've got an answer, but Gary, I'd like to hear yours first.
Like the easiest answer for all these questions is it depends. Because, right. It depends on the sophistication of the investor. It depends on their risk tolerance. It depends on what their strategy is. Like sure, and someone can easily say, oh yeah, condos is better or houses is better. But then it depends on the investor themselves. What are they comfortable with? So that's the short answer.
Yeah, like, my answer was actually also going to be, it depends. And the reason why is because I could take a house and it could actually be on the same block as another house, and they could actually be the exact same price. But let's say that one house can be refigured so that you can actually rent out the top and maybe even rent out the bottom, or split the bottom into two. Or maybe you want to get even more creative. You could rent out the top, and let's say it's close to University College of the Fraser Valley, and the 3 bedrooms up can sort of be rented out as individuals. to a bunch of college students, and you're willing to also put in the work. Now, let's say literally 3 houses down, you've got a house where there is, it really isn't appropriate. You can't split it up. There's no room for a separate kitchen at the bottom. And let's say both of these houses are $600,000. You know, one of them will have a significantly different cap rate than the other one, but at the same time, the other one will also require more work and more management. Uh, Now let's go to the condo debate. Well, what if I got a condo, Christian? Is that better than the house? Well, let's say that condo is in, you know, New Westminster, and it generates 1,700 a month in rent, and it costs, you know, 500 grand. But now let's pretend that someone says for $500,000, I could actually get a 2-bedroom condo in the Okanagan, let's say in Kelowna. Now, let's say that person on regular monthly rent can get, you know, in Kelowna, maybe $1,300 a month in rent. But let's say they only do 10-month leases or something like that. And they have the summer months, and they're willing to put in the work, and they furnish it, and they Airbnb it. Like, you know, you're going to get a significantly different cap rate over here. All right.
I just wanted to add to that, Christian. So if you have 500,000, you can even buy 2 condos in Abbotsford.
Oh, there you go.
And then have money left over.
Exactly. Or you could buy pre-sale. Yeah, exactly. So you might say, hey, I've got this one house. I have this one house for 500,000, but then you meet with Gary, and Gary says, well, why don't we explore that house as option 1? Now let's explore 2 condos as option 2. And then working with myself and my team, we would also help with the analysis for that. All right. So someone then is saying they missed the first session, and can they get a copy of the first one? Yes, you just have to email us. I will give you the email at the end. Ask it from my assistant, and we'll send it to you. The next question is, given the restrictions with Airbnb, how can a short-term rental strategy be implemented for condos to increase cash flow? Good question. Gary, you want to chime in on this?
Yeah. So with Airbnb, like 95% plus of condos in Greater Vancouver do not allow short-term rentals. So Airbnb, some of them, when they say short-term rentals, they go minimum 30 days or minimum 3 months. So you could actually implement quote unquote short-term rentals, just not daily short-term rentals. It can be 3 month short rentals or 6 month, or for those that have a minimum rental of 30 days, you could do minimum 30 days. So that's one strategy. A lot of strategies that other landlords have implemented that I don't support, but like, is that they just do it anyways. they just do Airbnb anyways, and then they pay the fine to the strata, and they hope they don't get caught. Or even if they get caught, they're like, oh, I get a $200 fine, but then, you know, I made like 5 grand this month. So I'm not condoning it or supporting it, but I'm just stating what happens out there.
Yeah. I think for me, if I was to explore the Airbnb route and talk to clients a little bit more about it, I would probably go along the lines of just find a building that allows the Airbnb, which is rare in Vancouver, but not so rare in other areas. Like for example, the Okanagan. The other one that I would recommend is to bite the bullet and try to buy a house, because there are no restrictions when you have a house, and you can get really, really creative when it comes to getting the house over here, such as, no one, like let's say a 3-bedroom house. A 3-bedroom house is appropriate for maybe a family of 5, but a 3-bedroom house for Airbnb, you could squeeze probably 10 to 12 in there easily. And it's because when people, if you think about a hotel room is like 300 square feet, and you have a family of 4 in there. Why? Because they're just sleeping there. right? They're not really spending a lot of time in there. When you think of a house and you think of 3 bedrooms, well, 2 in each bedroom, okay, that makes 6. If you have a sofa bed pull out in the living room, okay, that makes 8. If you have another area, any sort of a type of a living space, you can often do, get more creative and put another pull out there. You can get a cot, for a child, and put it in one of the bedrooms. A lot of families, they want their kids to sleep with them in the room. But what I found is that you can get a lot more creative when you actually own the house. You don't have the restrictions over there. And there's a lot of desirable areas that people are willing to come to if the price point is correct. Some people might say, well, yeah, wouldn't I have to be in downtown Vancouver or something like that? Well, the answer is no. There are people that are renting houses in Airbnbs, and they just want to know, how far is this from the downtown core? How far is this from, different areas? All right, let's get this last one in over here, okay?
Mhm.
Is including vacation property in your portfolio for a place like Vernon a good idea, where you can rent in the summer for the lake and in the winter for skiing? All right, what do you think, Gary?
I think it's good if you are willing to do the work, because all like you can rent a property, you can buy a property, a vacation property in Vernon or Whistler or Okanagan or Soyuz. It's great, but you do have to manage it, and you do have to, whether you're working with a property management company out there or not, you have to do your numbers, do your analysis. So it works if the numbers work, and whether you're willing to put in the work to find a property management company and such and such.
Yeah. I guess my big take on that is this vacation property are you going to use it yourself? There's a big question. Is it that idea of, hey, why don't I buy a property, and it's a vacation property for me. I'm going to use it a couple weeks in the summer, a couple weeks in the winter, but then I'm going to rent it out in every other month over here. And let's say it allows Airbnbs because it's a condo, or let's just pretend it's a house. Well, it's funny because I have worked with 2 clients in the last 2 months with that exact same question. And what we did was, working with us, we were able to help them to analyze properties that they were coming across, whether to say, yes, you should get this, or no, you should not, because of course they liked the idea of it, but they really, really needed the help. Make a long story short, one of them was able to get something, one of them was not. The search continues. And I guess we wanted to kind of highlight the pros and cons. One of the biggest cons is that it's work. It's going to be work. And the reason why it's going to be work is because who is going to manage the rental of the Airbnbs? Like, remember, Airbnb can be as low as 3 days. So if you want to get that thing to cash flow, you're almost basically investing in a second job, because, in order to get that cash, in order to get that money, you're constantly fielding emails, you're constantly fielding requests, and who's going to sort of manage the cleaning of it in between rentals? Now, you can get a property management company to do that, but a lot of them take quite a big bite of the profits. Now, you could also get a property management company that does all of it. So I guess, the quick answer, I guess the quick answer over there is that it depends on what it is that you are looking for and how much work you're willing to put into it. Uh, does does having property in Squamish that has cash flow? If yes, which part of? Okay, so this is this other question over here is a Squamish specific question. I believe what they're trying to say is, does having property in Squamish that has cash flow potential? If yes, which part of Squamish? So I think the question is there properties in Squamish that has cash flow potential? Gary, how familiar are you
For
with
sure.
Squamish?
I think Squamish, like most areas, Squamish is actually very popular. It's like very close to Whistler. It's really popular these days. The market is taking off there because of the vicinity to Whistler, as well as the desire for people to go camping now. It's
Yeah.
like outdoor sports have just skyrocketed in the last year because of COVID. People, like, all the campsites are all booked, they're all taken. A lot of people are moving out to like Squamish and Whistler, and like Cultus Lake, those areas, they just love it. So Squamish, is there potential for cash flow? Absolutely. Does it depend? Of course, depends on what you're going to buy, depends on your down payment, depends on a lot of different things, right? So for sure, the shorter answer is yes, it's a great opportunity. It's a great neighborhood too.
I think I have clients who live in Squamish. I have clients who want to invest in Squamish. So I've done some analysis on Squamish, and it depends on the property that you're able to find. It also depends on that magic down payment. As soon as you said cash flow potential, yes, how much down payment are you willing to put down will determine how much cash flow you're willing to get. Or, what I am able to help to do is to figure out, what is the break-even point, and does this make sense? Does it make sense with a comparison? So, I think what we'll do is we'll slowly start to wrap up. Working with some, what I advise most people who are looking to buy a rental property is to get a team. Get some people on your side who can analyze, because this is a very, very large purchase. It's not like buying, a computer or buying a car. This is a large purchase where it's not easy to get out of it if it's the wrong purchase. Get a strong team behind you. Gary, I can't say enough good things about. He really knows his stuff in the areas. He's able to do the comparisons. He's got this incredible system and process. It's very analytical, which is what I like, because I'm a very big analytical guy myself. And what me and my team do is we will integrate this with the rest of the areas in your life. Does this make sense from a retirement perspective? Does this make sense with the other things that you've got going on in your life over here from a cash flow perspective, with the integration of the steadiness of your income and your job and your pensions? So, what I want to do is thank you everyone for coming. If you are ready to connect, you could reach me at you can reach me at assistant@latitude-west.ca. I'd love to have that complimentary discovery meeting with you to understand your real estate needs a little bit more. And if you'd like to talk with Gary about getting his book or talking to him, from a real estate perspective, you can reach him at info@garywongrealty.com or at www.vancouverrealestatetv.com. A very last question over here, Gary says, is there any way to put down less than 20% for a second home?
So the short answer is no, but the long answer is it depends. The long answer is like, so if you're buying a rental property, according to mortgage brokers, 20% down is minimum. So how can you possibly get a property with less than 20%? Well, if you do joint venture. So with joint venture, meaning you partner with somebody else, and then maybe you put 10% down, they put 10% down. So that's a possibility. And then we can go into another webinar later on to talk more about how to do joint ventures properly.
Yeah, no, that sounds absolutely perfect over here. So I want to thank everybody for coming out and listening. If you're listening to the recorded link, same rules apply. Feel free to reach out to us. We're happy to speak with you. And Gary, we'll see each other in October, where we are going to be talking about comparing cash flowing real estate properties in BC versus other provinces. Okay, so we will talk to you guys soon. Keep an eye out for the next invite, and we should have this on our website to register for the October session in a few days from now. All right, thank you guys very much.